Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Craig Hemke. We're going to be recapping some of the economic data and forecasts from last week, and then also looking ahead to what is a busy week this week for more economic data. We'll see if that ever moves markets or how the markets react to it, but hey, as of right now, it seems like a lot of sectors have lost some of that upside momentum. Craig is the founder and editor of tfmetals.report.com. Craig, last week we got inflation data, which was, I thought, broadly in line, but some people are saying that it was higher than expected. GDP forecasts for the U.S. were also lower, down to below 2%. This maybe had some impacts on the markets that rolled over a little bit, but again, what we've seen in some of these markets are shallow corrections that are bought back. Today's not an example of that, so we'll see maybe if a downtrend is starting to develop. But Craig, your takeaway from some of that economic data last week.
Well, hi guys. At my site, we've been talking about, I remember that I think the first time I mentioned stagflation being the ultimate outcome of everything that changed with COVID and all of the money printing programs that went with it. I think the first time I mentioned that was June of 2020. And it's taken a while. We certainly seem to be headed in that direction. Inflation is persistent. Maybe not screaming along like it was a year ago, but it certainly is persistent, while at the same time, man, the economic data is coming in and falling quickly. Some of the data last week was surprisingly bad. We're now heading into a new week, this being Monday the 3rd, where we're getting a whole bunch of new economic data. The manufacturing sector PMIs came out this morning. The ISM version, which is a more closely watched, was way below expectations, considerably below the 50 level. And they say below 50, that's contraction and recession. So the manufacturing sector doesn't look too good. And we'll start getting some employment data. We get the JOLTS job openings data tomorrow. That'll be interesting to see what that shows. The service sector PMIs will then come out on Wednesday. That will certainly move the market because the service sector PMIs are kind of a pretty rough shape last month. And then finally, by the time we get to Friday, we get the next jobs report. I know it's only been a month, but it's easily forgotten that the jobs report for April, which came out on the first Friday of May, was actually below expectations for about the first time in a year, considerably below. And we'll want to watch that on Friday because Powell is on record on several occasions that I've heard my own 2 ears saying he's watching the job market closely because he's fearful that the Fed will keep rates high for too long and push the economy over the edge. And he wants to be able to respond quickly. And he has said that if, noticeable uptick in the unemployment rate, things like that, they will move to cut rates regardless of the inflation picture. Well, we'll see. Let's see what we get on Friday. And that'll obviously have a big impact on how the metals finish this week.
Well, Craig, when you think about the stagflation discussion and you're looking at things like inflation and the job market and energy prices and all of that weaving into a patchwork quilt of ideas that either give you the narrative of, hey, we're having a soft landing or no landing, or hey, we're going to have a hard landing. But really the stagflation argument is somewhere in between all of that. And we get a lot of pushback when we bring it up, Craig, because people say, look at the jobs market, look how strong it's been, despite the fact that a lot of people have serious questions about those jobs reports and they've been revised down lower most of the time. The job market overall has held up better than a lot of people expected. Is that the missing link here? Is that the piece that we need to see for it to be a stagflationary scenario? Because to your point, the inflation has stayed stickier and it's remained higher off prices that already inflated the last couple of years. Is it really the jobs that's the missing link here?
Well, and it depends on how deep you want to go into those reports. If you just go off the headline number, which is what most people do, they get the headline number on the first Friday of the month at 8:30 Eastern, and then that's the last thing that they think about it. Oh, look, it was better than expected, and that impacts the trade for a day. Then they don't really give it any thought. If you dig deeper into it, it's a lot of part-time jobs. You can dig into it. What are they? I don't know. They don't use the term migrant or whatever the right is where all the job growth is. Native-born American job growth is stagnant. I mean, you can dig into that report and come up with all kinds of ways to say it's maybe not all that it's cracked up to be. But even on that headline number, Shad, that Powell said he's watching that, and he's watching the unemployment rate too. And that did tick up last month. So we'll watch to see where we go, where that number goes. It's funny. People talk about the strong economy and how the stock market is strong and that's floating things up. But I think the majority of people, at least here in the US, they're not really feeling it that way. I mean, real wages are considerably lower than they were 3 years ago. Disposable income has fallen off a cliff. And so I think most people are so busy just trying to make ends meet, and they sense that they don't have as much money to spend as they used to. And that's maybe a more broad picture of the economy that people are dealing with, rather than just, oh, look at the unemployment rate says this and the stock market says that. Heck, I saw something from the Federal Reserve just 2 weeks ago, said 52% of Americans don't even have $2,000 in savings. Well, if you don't even have $2,000 in savings, you can give a rat's ass what NVIDIA is doing. You're just trying to make it day to day. And I think that is, again, that dichotomy is what leaves so many people perplexed about whether we have a strong economy or not.
Craig, back to that inflation data, though. You look at something like the CPI, it's been in a range here between 3 and 4% for a year now. Estimates are that it's going to kind of stay in around this range. So it's not like it's increasing from where it is, but it's generally higher than where the Fed wants it. Kind of in limbo here. I'm sure the Fed wants it a bit lower, but they would be worried if it breaks above that 4% level in any sustainable fashion. Is that also what you think the Fed is waiting for? A bit more of a decision in terms of where inflation is going rather than being really range bound for a year now?
Yeah, I mean, that they'll tell you, and everybody should know next week, whatever it is, Tuesday and Wednesday of next week, the 11th and 12th, I think that's right, is the next FOMC meeting. So you're going to get a whole bunch of coverage of that next week. And Powell's going to have his press conference, and we're going to get the summary of economic projections that we get every 90 days and the dot plot and all these other things. So we'll see what they have to say then. But for now, the song has been, and again, Powell's the guy that's going to drive the bus here. They want to keep rates high to try to kind of wring out inflation. But he has said they'll put that fight on the back burner if they sense the economy is beginning to quickly deteriorate. And it may be. I mentioned those PMIs. The Atlanta Fed puts out their GDP Now forecast. I don't know. They update it maybe once a week, twice a week, depending on how the data comes out. But they're projecting the GDP of the quarter. The official numbers don't come out until a full month after the quarter ends. But GDP Now tries to project it as they go along, based on the current data as it comes in. Now, for the first quarter, GDP Now thought we were going to be up north of 3%. It came in 1.6 and was just revised down to 1.3. So their GDP was way off and way too optimistic. Well, just only 3 weeks ago, that GDP Now model was projecting 4.2% growth for the second quarter. Well, now as we record this here on Monday, June the 3rd, it was just lowered again today down to 1.8. So it'll be very interesting to see how this all then plays out as we go through the summer. Is the economy finally stagnating? And we can come up with all kinds of historical markers in the past to say, okay, maybe how the length of time between when the rate hikes begin and when the recession begins, that sort of thing, or how many searches for the term soft landing and how that always seems to peak right before the recession begins, or all kinds of things like that. But the data itself is definitely seeming to roll over here as we exit May to June. So we're going to have to see where we go this month.
Well, Craig, is it possible that a lot of politicians and policymakers, and maybe even the Fed, have lost the plot here as far as the impact of inflation on the average person? Because they're worried about the rate of change. Is it going down 2% or 3%, or is it going down 4%? But if you look at the last couple of years of prices, they've already inflated so high year after year that we're talking about 2 or 3% inflation on top of prices that are almost out of range for most people, whether it's the housing market, automobiles. Look at what happened to used cars. I just saw a meme today of fast food prices from 2019 to 2024 at McDonald's and Taco Bell, and prices are up between 20% and 140% on everything on their item. I saw another meme today that said the most expensive vehicle that you drive today is your grocery cart. So is it possible that people are just out of touch with how much inflation has already happened and how that's impacting consumers?
Well, and again, that's just it. Who's actually doing the living and the breathing and the dying out here in the country? It's not the New York elites, it's not the bankers, and it's not the economists at the Fed. It's your neighbors. It's the people, the great unwashed, if you will, the large middle class, middle income group. And they're the ones that are stretched as thin as they could be. They're the ones that are fighting inflation and trying to make ends meet and picking up an extra part-time job to try to add to the income. And again, oh, wow, look at all these job growth. Well, is it job growth because businesses are rapidly expanding and growing, or is it, a guy gets laid off from his good job and he has to take 3 part-time jobs to try to feed his family? Again, so that's one of the challenges of all this is you get this economic data and news fed to you by CNBC and Bloomberg and the like. And they tell you how rosy things are, but at the grassroots level, like I said, where everybody does the living and the breathing and the dying, is that rosy or not? I sense that it's nowhere near that rosy. I mean, again, look at how great the stock market's doing. What percentage of the American population has an exposure to this, a real exposure to the stock market? 10%? So again, this is the challenge of trying to figure all this stuff out, but it's also the challenge of Powell. If he truly is a man of the people here to fill his dual mandate, then he's got to be aware of that. And he's got to be aware of what these high rates are doing, how that's bleeding over into credit card rates and mortgage rates and everything else, and the squeeze that's being put on the regular folks. So I sound like some kind of populist political candidate. It's a tough time, no doubt about it. Most American citizens in just trying to keep their boat afloat.
So what about the investment angle on this then, Craig? Because look, markets, yes, they have started to roll over again, but they did just touch all-time highs not that long ago. The market seemed to be strong. There's a number of areas that are doing well, and we've even seen yields at least come a little bit off of that recent run that they just had. Who knows where they're going, but overall, how do you transfer this all over to the markets, which have stayed strong? Well, a number of different areas have stayed strong.
Well, again, we've talked about this crack-up boom idea before, right? What's that, Austrian economic theory that you finally print so much money that everything goes up? So there's a little bit of a component of that. I'm not trying to say that there's not economic growth and earnings growth and companies that are doing great and that sort of thing. I just don't know how much of that actually is a reflection of economic strength as much as it is just money floating around. Again, it has to go someplace. It's like those GDP numbers that we cited earlier. If you try to compute in nominal dollar terms what a 1.6 growth of GDP is, it's something like $400 billion. But over that same first quarter of the calendar is the second quarter of the U.S. government, because the U.S. government fiscal year begins on October the 1st. Well, the U.S. government ran a $500 billion deficit. So if it wasn't for the deficit spending, would there have been any growth at all? And so there's all kind of, again, I'm trying not to obscure the point, in that the point I'm trying to make is this is really difficult to try to figure out for me, you guys, anybody, what really is happening from an economic standpoint. Can you look at just the markets and conclude and say, well, the market is always going to tell you the truth? Well, I'm not so sure about that either. It's an interesting conundrum. How's that?
Yeah, and often we can see a divergence between what's happening in the markets and what's happening in the economy. They don't always have to track. Often they're at opposites. So it's going to be interesting to see where the middle ground is between the two. But Craig, we definitely want to get your thoughts on the precious metals on the call. We always have people with questions that are now questioning the rally. Is it over in silver and gold because it's rolled over the last week or two? I guess I'd like to get your big picture thought on the move we've already seen in precious metals, where gold's broken out to a new high, silver's broken above 30, copper made a new all-time high. Do you think there's a lot of life left in this move, or do you think maybe it did get too far ahead of itself?
Well, guys, you know from talking to me over the years, as I understand the way these markets trade, in a bull market, they're always going to move 2 steps forward and 1 step back. And you get these rushes of speculative money that come in, and then you run out of momentum and price pulls back and the speculative money rushes back out and it kind of gets all washed out, and then you're ready for your next leg up. And that's kind of how it goes. I've seen people, here as June begins, I saw some stuff over the weekend saying silver is going to $50 this month. And I'm like, well, I'd be surprised if that happened. Because typically, like I said, you come up, silver goes up in stages. As an example, remember we talked about how to get it above 26 first, and then it had to get above 28. But then it had to break out above its 4-year price range and get above 29 and 30, which it has done. But anything else, you get a breakout. What was resistance then becomes support. So you got to come back down then and test that support and consolidate before you can move higher again. So the next move is probably not straight to 50, but I still think we could eventually see 34, 35, especially as we get into a period of maybe we're talking about rate cuts as we get deeper in the summer and the early fall. But again, we're moving up in stages. Gold's the same way. I mean, we finally got above 2,000, 2,100. Then we added 10% on top of that, maybe a little bit more than that. And gold, just like the chart of silver, now is kind of consolidating in a range and moving sideways and unsure of what to do next. So I would suspect that's what we'll continue to see, though, again, this data this week and the Fed next week could change everybody's outlook. I mean, what if, I'll just pose this scenario, what if we get a really lousy service sector PMI number on Wednesday, and the jobs report on Friday is way below expectations, and the unemployment rate ticks up 0.2. And then we go into the FOMC meeting next week, and all of a sudden the dot plot has changed, and Powell's talking about, oh boy, the recent economic conditions have showed significant weakening or something like that. Well, heck, we could be back above 2,400 and charging higher in no time. So how's that for a long answer that said nothing? It's not surprising that we would be range bound after the rally we had, I guess what I'm saying, in March, April, and into May. That's how these markets roll. And now we'll just wait for the next catalyst to hopefully send us even higher.
Craig, what about your thoughts on the gold-silver ratio? Recently dropped below that 80 level. When we do see silver outperforming gold, that's usually better for the stocks. It shows a bit more of a bull market, especially when prices are going up, which they have been. Do you pay any credence to this gold-silver ratio now below 80?
Well, personally, I don't. I really don't give it much thought. I've actually seen people do technical analysis of the gold-silver ratio, which that just doesn't do anything for me. However, I have to acknowledge that there are hedge funds, there are programmed algorithms, commodity funds, whatever, that do take that into account. You know, that maybe if the gold-silver ratio is breaking below a historical level, that then maybe let's sell some gold and let's get into silver instead because the ratio is coming down. I got to figure there are some people out there that look at that where there's probably some computers that have been programmed that way. But in terms of just the ratio, I mean, just not something that gets me too excited.
Well, Craig, I do know that you follow the commitment of traders reports pretty closely for gold and silver. And we've had some interesting points of view, a range of ideas on this, where some people look at the speculators and the hedge funds as the dumb money and the commercials as the smart money. We had an interesting comment recently from Jeff Christian where he said, really, the commercials are simply a inverse, like a mirror inverse of the buying interest or lack of buying interest from investment demand. So basically, they're making the market and they're taking the other side of it. So if everybody's going long, they go short. If everybody's going short, they go long. What are your thoughts on that as far as parsing out the importance of the COT numbers and the two different camps of investors they track?
Let's just relate it to where we are at present, because again, as you get into the later stages of a rally, whether it's in the short term, the intermediate term, whatever, you get these. Again, if you track these reports every week, as I do, again, there are noticeable patterns where all of a sudden all the hedge funds are getting long, and their position relative to open interest and whatever gets kind of heavy from a historical basis. Where you go, well, the last couple of times the hedge funds or those large speculators have accumulated this large of a net long position, price has peaked. And you could make the case that, well, basically everyone that's going to buy is bought. Now you've got more sellers and buyers, and down it goes. It kind of works that way. There is some reason to be concerned, maybe more with gold right now from a commitment of trader standpoint than silver. Silver it's a lot of open interest, but the positions relative to the net position, I should say, is not outrageous by any historical measure. The only thing that bothers me with gold is as we wrapped up the June contract, and there were all kinds of liquidations next week, and got to get out of the June contract and roll forward into August or into December or whatever. We were left with mass large speculator if you're a hedge fund, even selling of longs, but also covering of shorts. So as price was falling during the most recent commitment of traders period, which ended last Tuesday, there was, actually a change to the net long side of these large speculating hedge funds. So when you look at that table that a lot of people see on the legacy report, that category, large speculator, has the smallest gross short position. If you just add it all up, there's a gross long and a gross short, and you subtract one from the other and you get a net position. But just in terms of total gross amount of shorts in gold is the smallest it has been in 4 years, going all the way back to 2020. If you think of that as fuel for a rally, short covering, right? If there's not a whole lot of shorts left to be covered, then that's one part of the potential buying to drive price higher that's not there. And so that's a little bit of a warning signal for me in terms of commitment of traders report as they stand, at least as of last week.
All right, Craig. Thanks for your insights as always. This is a big week. Next week is a big week. And then things really slow down for the markets. They already feel like they've started to slow down, but we'll see if any of the data points, the Fed meeting, or anything else it puts us in a new trend or even gets some more excitement as we transition into summer. Always great chatting with you, Craig. We'll chat with you next week. Have a great rest of your week.
Thanks, guys.